Good morning and welcome to Momentum Global Matters. My name is Ray Mere and I'm Head of Investment Distribution here at Momentum. With me in studio is my colleague, Kapil Joshi, who's the Head of Momentum Collective Investment Schemes. So Kapil, what do you think of our new three-dimensional studio here?
I think it's amazing, and I love how Momentum Investments has embraced the future with our events in the last 12 months. For all of you watching at home, let me tell you a little secret. None of this is real. Not the plants, not the couches, not the walls, the floors, or the ceilings. Ray, should we show them where we really are?
Why not? For everybody tuned in today, we have an incredible lineup of investment experts from around the world who will be sharing their insights and views about the past 12 months and also the road ahead.
But before we get to our first speaker, just a few things for all of you to note. Not only did we build our new beautiful virtual studio, we thought it also needed a home. You're watching this from our brand new Momentum Investments events website. This website has a couple of really neat features. At the top of the landing page, you will see that we give you access to our agenda, profiles for each of our speakers, and a great way to navigate this conference.
In addition to that, our download section has links to all the presentations, information packs from all our presenters, and links to video content you might find interesting. As we move into the future, this website will continue to grow and become your home for investment information. Our investment specialists are on hand to answer any questions you may have during the event, so please post your questions in the chat box for us to respond to them. If you need any more information regarding our capabilities or investment solutions, please request a callback and we'll get back to you as soon as possible. Kapil, shall we get the show on the road?
Let's do that. Welcome back. Next, I would like to introduce Richard Stuckley and Robert White, a portfolio manager and senior analyst at MGIM in the UK, as well as Natalie Harrison, who is the global fund specialist at Momentum Investments based in South Africa. Richard, with an estimated 630,000 publicly traded companies globally and more than 40,000 funds, what role does investment research play?
Well, good morning, Kapil, and good morning to everyone listening. As you say, does investment research have a critical role to play? Well, just listen to the numbers you quoted. Over 600,000 publicly traded companies for investors to choose from. More than 40,000 professionally managed funds. Some sources put that figure closer to 100,000, in fact. So I would question, how does one go about selecting a sensible subset of investments from that enormous opportunity set without investment research? Now, at the same time, obsessively trying to research everything is a key mistake that some investors make. You simply can't do it. The problem is too large. And instead, what you end up doing is just wasting time. What we at MGIM endeavor to do instead is to spend our time wisely, condensing what is a huge problem, i.e. all of those different things you could buy, into something more manageable. Okay, here are those numbers again, plus a couple of others. So starting in the top left-hand corner, at MGIM, we look at opportunities across 15 liquid asset classes, from equities through to commodities. Moving clockwise then on the slide, the next item shows that we look across 195 different countries. Now, clearly, investment opportunities are not evenly distributed across them, but nonetheless, there's a lot to look at. Next, as we've already heard, there are 630,000 listed companies we could either lend money to or else buy participatory interests in, i.e. shares. And finally, there are at least 40,000 professionally managed funds, as shown bottom left. So then, faced with all of this choice, what are you going to pick for your portfolio? Well, the first question I think you should logically ask is, does it matter what you choose? Could you not simply select investments at random for your portfolio? Well, history shows that not all investments are created equally, unfortunately, as this chart tries to illustrate. If you had chosen to invest in commodities over the past 3 years to the end of March, you would have lost over 15% of your initial investment. If, on the other hand, you had allocated to developed market equities shown at the top, well, you would have gained close to 50%. So therein is a nigh on 65% spread. There are, therefore, a wide range of possible outcomes, and not all investments are destined to appreciate in value, I'm sorry to say. Even an investment that is ultimately destined to go up over time will not necessarily do so in a straight line. This chart, looking at the performance of global equities, shows that at times investors will be sat on very meaningful short-term losses. Therefore, not only do you have to pick a sensible portfolio of investments, you also need to have the conviction to stick with it during the inevitable bouts of volatility. Finally then, on this slide, having firstly acknowledged that the opportunity set is wide, and secondly that the range of potential outcomes is wide, there is also a wide range of questions that you need to consider. Starting in the top right-hand corner on this slide and working our way around clockwise, if you choose to invest in professionally managed funds, first think about what type of structure you want, be it an ETF, which provides intraday liquidity, or a more traditional mutual fund. Make sure you understand the costs and benefits of both, and in particular, under what circumstances an ETF can start to trade at a meaningful discount to its net asset value. Next, pay very close, I would say nigh on obsessive attention to liquidity. That's the next item on our list as we move clockwise. The wrong liquidity profile can lead to the permanent impairment of your capital if you are forced to sell your investment at the wrong time. It is possible to hold less liquid investments in a portfolio, but sizing is a key consideration in order to avoid becoming a forced seller. Next, how do I judge whether a professional fund manager is skillful or just plain lucky? Well, at MGIM, we evaluate managers across 45 different criteria, and we evaluate their historic performance and also liquidity across no less than a further 40 criteria. Critically, I would say make sure you understand your manager's structural biases. It may be that they never invest in the energy sector, in which case we should neither credit them nor penalise them for any performance that arises related to not owning energy. Next, is there a role in your portfolio for systematic strategies which seek to deliver outperformance through predictable rules-based portfolio construction? We think there is, and so our equity and fixed income solutions both feature some systematic managers. The list goes on. Next, pay close attention to fees clearly, but also consider net of fees returns. Cheap is not the same as value for money, and sometimes it is worth paying up for better prospective performance. The debate over active versus passive management goes on. We caution against being wed to either. In certain asset classes, a passive approach makes sense, and in others, there are very good opportunities for active managers. And finally, how should one go about incorporating environmental, social, and governance factors into one's investment analysis, bearing in mind that environmental objectives are at times not aligned with short-term social needs? The answer is it takes a huge amount of ongoing research and also engagement with companies. A lot of questions then, and thank you for bearing with me, but clearly these are just a very small sample of the questions that we all as investors need to take account of. Addressing a wide opportunity set, number one, a wide range of possible outcomes, number two, and finally, that wide and constantly evolving set of questions needs a dedicated research resource, I would suggest. Along with Robert and Natalie, who is shown on this slide and who you'll hear from momentarily, I am primarily responsible for the global investment solutions we manage on behalf of South African investors. That said, we three are just a very small part of Momentum's dedicated global investment resource, as this slide shows. You don't need hundreds of people doing investment research. Indeed, I'd suggest that you don't want hundreds of people. The more people you have, the more time is spent on managing them, and the less time invariably that is spent on managing client capital. You do, however, need a decent headcount. In conclusion then, and thank you for listening, investment research has a critical role to play in helping investors grow their savings, and we think we have the right scale for the task. Thank you very much, as I say, for listening.
Robert, now that we know we should rely on a credible research partner, tell us how you select or identify the best in-class specialists from around the world.
Okay, thank you, Kapil. So there are a couple of problems you need to solve for when searching for a credible research partner. So firstly, as already has been touched upon, the available universe is huge, so you have to filter it down. Secondly, the average manager underperforms the benchmark, and so you're fighting an uphill battle from the start. So let's start with the second problem, as it's the throughout our entire business, we currently only allocate to around 130 active managers, and so we can afford to be highly selective in who we choose. For us, the average is nowhere near good enough. We're looking for something truly exceptional when we allocate to third-party specialists. So we have a detailed set of criteria by which to judge managers, and we apply the same framework to all potential new investments. This results in a scoring system, and here we can objectively compare and contrast managers with one another and rank them based on a number of criteria. So the key high-level factors we look for when selecting specialists are the firm, the team, the strategy, risk flags, and performance. And I can touch upon each of these briefly now. So with regards to the firm, we only want to be invested in healthy businesses that are well run and provide a supportive environment for the investment staff. So this comes through particularly in the remuneration structure, where we look for the key personnel to have appropriate alignment with us as investors. So our favourite businesses tend to be manager-owned private boutiques, and these are run by investment people with a long-term horizon in mind. So typically the portfolio managers, they want to run money for their entire careers, and that sort of longevity matches nicely with the typical investment horizon of many underlying investors who will be saving for long-term events like retirement, for example. And when we assess the strength of an investment team, we obviously make sure that they are well resourced and have the appropriate experience and track record to run that particular mandate. Just as important, however, is to understand the culture of the team, how decisions are made and to what extent there is any key man risk. Ideally, we look for teams with broad experience, so if the lead PM gets hit by a bus, the team can continue to run things well. But another really underappreciated attribute is the focus of the investment. So in large businesses, sometimes some managers and analysts can have their attention split between a number of competing requirements and different strategies. Our favoured setup really is to back a team that can spend the majority of their time running one core strategy or slight derivatives thereof. And that's really so they're not dividing their attention across multiple different projects and can really focus on what we're paying them to do. So the team and the firm are obviously important, but when we do our scoring system, we put most emphasis on the strategy, and that encompasses the entire investment process, the philosophy, and that includes portfolio construction, risk management, and ESG considerations. Consistency is the key thing here, as having a repeatable, robust process really helps the very best managers to add value throughout the ever-changing economic landscape. We look for managers that have spent some time fine-tuning their approach and who have shown that they can withstand the most challenging conditions. And we've certainly seen that they can occur really from left field in recent years. And this really ensures they have the courage and conviction to stick with their process when times get tough. The best way for us to find these managers is through frequent manager meetings. So our well-resourced team spends a good portion of their time meeting with potential new managers, and where we can quiz the PMs on particular stocks and see if their explanation is consistent with what they say about their philosophy. This is a crucial issue at the moment, particularly with regards to value managers, as many of them have shifted to become more growth-like in recent years. And this is really because the last decade or so has been particularly difficult for value as a style. So that sort of style drift is important to identify when you build style-balanced portfolios, as we do. So our highest conviction value managers have been following the style for their entire careers. We have built confidence in their adherence to that philosophy by monitoring them either at their current firms or at previous firms, for well over a decade in some cases. That sort of closeness to managers really kind of helps you build confidence in this consistency, and it's a real vital part of what we do. So I think here I'll briefly mention some of the quantitative tools we've developed, and that helps us with this analysis. One of these is customized style analytics reports. So we use these to quantitatively define what it means to be a growth, value, or a quality manager. And we run historic Z scores, which show how managers rate on those metrics. That's based on their historic holdings. We also run trading reports, which show at which points managers buy and sell important stocks, as well as customized attributions, which show how they have generated performance. All of this information is compared with our qualitative assessment of the fund and helps to inform our questioning when we meet with managers. The key thing we're looking for here is, are managers doing what they say? Another aspect we look at is performance. And generally, we think investors tend to put too much emphasis on past performance, and it's actually a comparatively small part of our overall assessment relative to the other factors that I've mentioned. But nonetheless, it does reveal some interesting information. We weigh up relative performance against the appropriate style benchmarks, and we read as much into risk data, such as drawdowns and tracking error, as we do to return data. So many of our peers have some arbitrary time requirement for track records. Typically, this is about 3 years, and that's before they even look at a manager. We think this is a mistake, as investing earlier often leads to additional benefits, such as capturing excess returns, before a fund has grown too large, which happens, relatively often, and also accessing any reduced fee share classes that may be available. When we have conviction in a manager and they've shown they can run a comparable fund well, we're happy to invest in an early stage. So the last really factor to mention here, but by no means least, is the importance of risk flags. So we have a number of risk flags here which would preclude investment in any manager, no matter how high our conviction was in any of the other areas. So the most important risk flag to mention here is liquidity, which Richard briefly touched upon. So we run liquidity analysis on the portfolios that our managers run. And this gives us an idea of how quickly they could move everything to cash in the most distressed market environments. If there are sufficient risks that managers won't be able to meet their obligations due to liquidity mismatches, these are complete red flags for us. And where we do want to access inherently illiquid asset classes, typically property or private debt, for example, we do so through closed-ended investment trust structures, which are much better vehicles for accessing these areas compared to daily dealing open-ended vehicles. So sustainability is also a crucial component, that runs through all of our analysis, both at the firm and the fund level. This isn't something that we just bracket out into a separate score. It's really integral through every stage of our scorecard and our whole analysis. So any firm that we partner with is assessed based on its environmental, social, and governance credentials. We consider things such as the composition of the board, the treatment of various stakeholders, and environmental credentials, and so forth. And we complement this external data from Sustainalytics to ensure that portfolios are run in a sustainable manner. So going right back to the start of my answer, these two problems. The other problem was, how do we narrow down this universe of 40,000 odd funds? So we take a few different approaches. So firstly, simple screening definitely has its place. So we have access to all the usual databases like Morningstar and Bloomberg, and we look at overall performance as well as through specific time periods. The specific filtering criteria we use will depend on what we're looking for. A quality manager, for example, will be expected to outperform in down markets, and so will be more likely to screen on numbers such as downside capture or Sortino ratio, for example. When screening for growth managers, we like to look at managers who have been following their style even when it was out of fashion. So we might look further back at performance in the run-up to the financial crisis, and that's an example when the macro environment was very different. The one key advantage of screening is that you can find managers who may not have funds for sale in the UK or in Europe, but still have funds with impressive track records that may only be eligible, say, for US investors. So our ability to set up customized managed accounts means that we don't need to wait for these managers to launch products in the UK or Europe before we partner with them. We think this is a pretty significant edge, and that gives us the ability to partner with talented investors earlier than some of our peers. And we've had great success in this regard with some of the managers currently in our global equity fund. Of course, the risk with screening is that it tends to throw up funds that have already performed exceptionally well, and we all know that past performance necessarily guarantees future returns. So the other way really to narrow the universe is through utilizing our existing network. So our investment team have a wealth of experience, and through that time, we've developed a good sense of the leading specialists within each asset class. Of course, each of us has our favorites, and on an individual level, we're all susceptible to personal behavioral biases. But that's why our whole approach to manager selection and asset allocation in general is team-based. Whenever we make a decision to partner with a manager, the whole team sit down and discuss the relative merits with known peers, and we really bring our experience to bear. And then finally, we arrive at a collective decision. Also, this is really a feature of how we work generally, and particularly when we're in the office. Again, it seems like an age ago, but we speak regularly and exchange views on individuals and firms, who we've met recently, and that in itself is a great way to focus our research. So really, I think that's a good summary of how we tackle this challenging issue, really. But as always, we're very engaged. We're always happy to discuss things further as required. So with that, I think I'll bring my answer to an end and hand over back to the rest of the team.
Thank you, Richard and Robert. To hear the role research plays in making the right investment decisions is incredibly insightful. That is why it is so important to partner with the right investment managers. So let's delve a little bit deeper and look at one of those styles in a little bit more detail. Natalie, is quality the only answer for building resilience into an investment process and portfolios?
Thank you, Kapil. Building resilience in a portfolio is not one-dimensional. Yes, quality businesses with robust profitability, attractive return on equity, pristine balance sheets, strong brands, and pricing power provide protection, especially during periods of low economic growth. And Robert actually alluded to this earlier. But these defensive qualities often come with a price, with quality counters sometimes trading at a premium to their intrinsic values. With the MSCI World Index, Quality Index, comprising more and more of IT stocks in particular, a lot of these quality counters have become amongst the pandemic winners in e-commerce and online, which has now pushed their valuations up even further. This chart here, as an example, highlights the tremendous growth achieved by well-known tech and consumer services companies over the last few years. As can be seen, their total market capitalization has risen from $1 trillion in 2012 to nearly $8 trillion at the end of March 2021, a nearly 800% increase in less than a decade. So with the valuations of some of these quality counters such as Apple, Microsoft, and Facebook becoming stretched, it is actually these counters that are at the biggest risk of a sell-off, especially if, or should I rather say when, real and nominal yields start to rise in the future. We have already started to see some of this rotation from some of these pandemic winners to those sectors which have suffered most from lockdowns and the sudden halt in activity. And this trend will likely continue as the economic recovery gets momentum. So yes, quality counters can provide resilience because of the nature of their business models, the inelastic goods and services they provide, and their strong return on invested capital metrics. But as always, the price you pay for an asset, no matter the quality, is still a critical consideration, and some of the quality counters may not provide the resilience as expected. On this point of resilience, what is of interest to note is that quality is not the only style that provides protection in periods of market turmoil. Value stocks have actually outperformed the market during some historic bear markets too. This slide here, for example, plots the performance of value companies against the S&P 500 during 4 of the last 6 bear markets. The x-axis highlights the beginning of the market sell-off to the point of the market recovery when the S&P was right above water again. What you can clearly see in these graphs is that value stocks, as represented by the blue line, outperformed the market, or in the case of the Gulf War, provided significant protection during the initial market sell-off. Now, I'm not saying that value stocks will always outperform or be resilient, because during the last 2 crises, value has underperformed significantly. Instead, I'm trying to put these 2 most recent crises in context, because in very different economic circumstances, value stocks have clearly provided resilience. So the notion that value companies are poor quality companies that will perform poorly in bear markets is not always the case, and it's very important to remember that point.
That is an interesting point. You are right. Recency bias may lead people to think that value stocks do not provide resilience during bear markets. So clearly, investment styles perform differently in different market circumstances. Neither quality or value should be used as a one-stop shop solution. How do you go about building resilience into an investment process and portfolios?
Yes, you're correct, Kapil. In order to ensure resilience and increase the probability of our portfolios achieving their return targets over time, we look beyond one equity style or asset class to drive build portfolios that not only participate in rising markets, but also provide protection should things turn for the worst and there is a sell-off in risk assets across the board. So how do we go about doing this? The answer is quite simple. Through the consistent application of our outcomes-based investment philosophy that adopts true international diversification and unrivaled flexibility to not only seek returns, but also eliminate unnecessary risk where possible. This chart here, as an example, highlights the multi-layer diversification we use within our portfolios. We look beyond traditional asset classes like bonds, property, cash, and equity to areas such as alternatives, credit, convertibles, real assets such as infrastructure, and of course, precious metals. Richard actually mentioned earlier that we look at 15 asset classes in total. We diversify further across different regions and sizes. Within equity, we follow a blended style approach across value, growth, and quality factors. And then finally, we also look to diversify across currencies and investment strategies. Ultimately, we believe there are many levers to pull to enhance the risk-return outcomes of our portfolios, to make the investment journey more palatable for our clients, and also to seek additional returns in this low-yield environment.
So, diversification is key to your process. Could you dig deeper into a few of these concepts? How do you look at diversification in terms of asset allocation, investment styles, and managers as an example?
Kapil, from an asset allocation perspective, we look to own the right combination of assets so that the overall portfolio behaves positively across a wide range of macroeconomic scenarios. Here, it is very important to increase the opportunity set of asset classes so as to increase the diversification benefit, as represented by this blue bar in this graph, and hence reduce the risk reduction benefit of the portfolio as much as possible without sacrificing on the portfolio's return objective. The higher the diversification benefit, the greater the resilience, and hence the easier it will be for our clients to stick with their investment journey and ultimately reach their investment outcome that they're wanting to reach. From an investment style perspective, quality, value, and growth investment styles have been shown to generate excess returns over time, but tend to outperform during different market circumstances, as I touched on briefly earlier. As shown by this particular graph, our research shows that blending these complementary investment styles, being quality, growth, and value, is the best way to not only generate excess returns, but also minimize risk and make the investment journey more palatable for our clients. And this is clearly illustrated by this red line on this graph. Furthermore, the factors driving each of these styles are sufficiently distinct and independent that they provide additional diversifications for our portfolios too. Now, in terms of how best to access these styles and asset classes, we look to partner with the specialist asset managers per asset class, per investment style, and per strategy, whether it be active, passive, or systematic. In today's diverse marketplace, we believe that there is no single asset manager that can adequately access the variety of opportunities on offer. And that is why we look to diversify across the best managers we can find across the globe. And Robert touched on just how we look to do that. In addition to diversification, we adopt a strong risk management process and use proprietary risk analysis tools to consider the impact various macroeconomic scenarios have on our portfolio returns, as well as how active allocation positions contribute to intended and as well as unintended risks. Ultimately, over time, returns are rewarded for taking on risk, but our strong risk management process will seek to identify and reduce and hopefully eliminate exposure to all those unintended risks. And the reason why we do that is because we want to generate robust returns for our clients and limit volatility where possible. So, Kapil, to answer your question, is quality the only answer for building resilience into an investment process and investment portfolios? We believe the answer is no. A robust risk management process and true diversification across risk and defensive assets, equity styles, asset managers, currencies, and regions is the best way to mitigate risks and enhance returns over time. With market volatility expected as we head towards and then through the economic boom that is sure to come, this philosophy and process couldn't be more appropriate now.